So the headlines of the autumn budget are effectively this big increase in spending over the next 5 years. So a 70 billion increase every year over the next 5 years, and that's being funded half and half, basically, a split between tax rises, so about 36 billion in tax rises, and a similar amount from borrowing. Tax rises, there's a number of tax rises in there, but I guess the headline is the 25 billion that's going to come from an increase in national insurance contributions from employers rather than employees. On the borrowing side, they've announced a change in the fiscal rules, to allow that borrowing. So what they've done effectively is move to a net debt rule. Focusing on net debt, and what that means is a bit like a company's balance sheet. They're going to bring the assets into the equation as well as the liabilities. So they're looking to offset the liabilities with the assets. So effectively what they've said is they can increase their headroom, they can increase borrowing, as long as that borrowing is for investments that are going to generate a return. Now, to keep markets happy, international investors happy, unlike the mini budget and Liz Truss, the focus is around the right guardrails to be put in place around this spending. So, i.e., this spending needs to generate a return, and they're looking at, they've got a few measures around this, but one of the key measures is going to be that this, any investment needs to generate a return over and above gilts, which is their cost of borrowing effectively. So it's actually a net positive, hence they can offset that then in terms of the calculation around borrowing. So this is a monumental increase in spending and also a monumental increase in borrowing. In fact, I think it's aside from any kind of pandemic or crisis, this is the largest increase in borrowing since the Second World War. So obviously these measures are seeing an increase in borrowing, an increase in spending. So that is inflationary, and looking at the OBR's initial forecasts around this, it looks like it's about a 0.5% increase in inflation. So that's something we've got to be aware of. Obviously, interest rates have been coming down because inflation has come down. A 0.5% lift in inflation is not so bad, considering the latest reading was slightly below the inflation target. So if that stays like that, then that's manageable, and you know, overall the positive spending should be good for the economic growth. And I guess from a investor's perspective, from the market's perspective, UK PLC growing again, the UK economy growing is a positive. And so the measures around spending to get the economy growing are a positive sign for sure, and it's a huge increase in spending, and front-loaded as well. So it's coming in the early years, so that's going to hopefully mean that the impact is felt sooner. The one, I guess, caveat to that is, do we have the capacity to absorb that increase in spending so quickly? So when I say increase in capacity, think construction workers. Do we have enough construction workers to go and do this building that they want to do? Do we have enough planners in terms of the planning reforms and actually granting planning permission to go and put this infrastructure in place? So those are some of the question marks. Also, obviously, we talked about the increase in tax rises and certainly the national insurance contribution by employers going up. So the increase is 1.2%. The OBR have said the expected pass-through, so what they expect to happen is about 0.6% will be passed on to either us as consumers in terms of higher prices, or it'll be passed on in terms of slightly lower wage increases for employees. So that leaves about 0.5% that'll be a margin impact for companies. So it is worth thinking about in terms of from a UK PLC point of view. I guess there's pros and cons here. The pros are more stimulus to get the economy growing, should grow faster, and infrastructure being built, etc., better rail lines, all helps in terms of the economy. Flip side, negative, is that it comes with some cost, and that's going to be borne out in inflation, and that's going to be borne out in terms of that impact on margin as well.